Welcome back to Investing Talk Podcast.
Today, we're looking at Vale.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have some pretty significant information surrounding Vale, and the Q3 numbers really set the stage.
They were pretty strong, weren't they?
They really were. The company reported $10.42 billion in revenue and an EPS of 63 cents.
And both of those surpassed analyst expectations, right?
Significantly. It wasn't just a small beat. They were well ahead of what the street was looking for.
That's a strong beat, but mining is all about efficiency, isn't it? I mean, what's the core driver of that performance?
It comes down to really two things: costs and quality.
Okay.
Vale is positioning itself to be the world's most efficient iron ore producer. Their TTM gross margins are 34.78%.
34.78. And how does that stack up?
Well, it significantly beats the industry median, which is closer to 28.1%.
That's a huge gap.
It is, and it's driven by these incredibly low C1 costs. They hit $18.08 per ton in Q4 2024.
$18.80, wow.
Which is the lowest we've seen since 2022.
Okay, let's unpack this for a second. That efficiency, it translates directly into returns for investors, which is where it gets really interesting.
Right.
What does the balance sheet look like in terms of shareholder returns?
It looks very robust. They've gone through a deleveraging phase, so now they have this strong free cash flow supporting massive shareholder returns.
And we saw that in action recently.
We did. They recently paid a special dividend of $0.23331 per share.
Not bad at all.
But the really eye-catching number is what analysts are projecting. The dividend yield for 2026 could, and this is an estimate, but it could reach 9%.
10%.
Which is twice that of its peers.
That's an incredible number.
It is. And when you look at the Q3 net profit of $2.68 billion on that $10.41 billion revenue, you can see the engine is there to support it.
That 9% yield is certainly eye-catching for anyone looking for income. But what protects that cash flow long-term? I mean, they are a commodity producer, so competition is fierce.
The moat is multi-layered. And you're right to question it. The first layer is the quality of the product.
Right.
Vale's high-quality ore averages 63.6% Fe content, and their premium Carajas ore hits 65%.
65%.
And this high quality commands a price premium, especially as global demand shifts toward low GHG steel inputs.
So this is the green steel movement we keep hearing about.
Exactly. They are strategically vital for it.
So it's not just about digging dirt. It's about digging the right dirt. And I know the market has been focused on their diversification strategy. How is their base metals segment shaping up?
This is a key growth area, a really key area. Base metals, so copper and nickel, they add necessary diversification.
And what are the targets there?
They're targeting 5.4 million tons of nickel by 2025 and 400,000 tons of copper annually by 2026.
That seems ambitious.
It is, but this segment is already exceeding estimates. It actually beat forecasts by 30% in Q2 2025.
30% is a huge beat.
It is. So this acts as a major offset to potential volatility in the iron ore market.
If the fundamentals are this strong, why the recent volatility? We saw shares gap down recently from $13.29 to $12.64. What does the technical side tell us?
Yeah, that gap down was tied to weak near-term sentiment, but the underlying structure, it actually suggests mid to long-term accumulation.
Accumulation while the price is dropping. How does that work?
Well, analysts are noting that higher lows are forming post-earnings beat.
Yeah.
So even with that dip, there's a hidden bullish divergence in the RSI and Man-ED signals for midterm horizons.
Here's where it gets really interesting. Who is buying this dip?
It's the institutional flow. It's in a clear accumulation phase. Sentiment is net bullish overall, driven by that Q3 performance and some key analyst upgrades.
Like RBC, I saw that one.
Exactly. RBC recently upgraded Vale to outperform. They set a target of $14.20.
And they cited delays at rival projects, right? Like Simandou.
Correct. Which obviously favors Vale, and we're also seeing cluster buying.
So multiple big players moving in at once.
Yes. Senegon acquired nearly 2 million shares. Kawa increased its stake by 50%, and Lazard added over 1 million shares.
Wow.
That kind of movement signals really strong institutional confidence.
So what does this all mean for the risks? Every investment has a bear case. Where does Vale look vulnerable?
There are two primary risks. First, the perpetual concern. China, iron ore, demand softening, or, new supply entering the market.
The classic worry for any iron ore producer.
It is. But this concern actually factored into that recent 4.5% gap down, which suggests it might already be partially priced in.
And it's mitigated by their high-grade ore anyway.
Exactly. The premium helps, and so does the strength of that base metals segment.
And the second risk, which has historically been a significant issue, is related to legal and dam liabilities.
Correct. You can't ignore that. Legal setbacks and outstanding dam liabilities, like a recent $500 million charge, they are ongoing risks.
So how are they handling that?
Well, the company is actively de-risking this. They're implementing structure closures by 2035 and introducing a comprehensive new risk management policy.
So a real structural overhaul.
A complete overhaul of safety and sustainability, and their massive free cash flow generation is really key to managing these liabilities without hurting the core business.
Looking ahead, what should our listeners monitor in the next 3 months?
Q4 earnings, they're expected in early February 2026. We'll be watching for continued momentum in iron ore and base metals.
Seeing if those beats continue.
Exactly. And macro factors are also looking pretty favorable.
Rate cuts?
Rate cuts and sector rotation. They usually benefit materials companies, especially one with an estimated 9% yield.
Of course.
And then there's also speculation around a potential base metal separation
Now,
and a rumored $5 billion green hydrogen investment through 2030, which could draw future partnerships.
if we connect this to the bigger picture, Vale's low-cost, high-grade iron ore dominance, paired with ramping nickel and copper production, it really positions it as a powerful cash flow machine.
It does. And the institutional accumulation and favorable macro environment make the multi-year hold targeting those 2026 production ramps a very compelling thesis right now.
This raises an important question for you, the listener. How much value do you place on a company with exceptional margins driven by premium product quality, even amid market volatility? Think about that positioning against the backdrop of global green infrastructure demand. If you want more in-depth analysis like this, make sure you hit that subscribe button.